Ben Miller with us today. He is the CEO and I believe a co-founder, he'll correct me if I'm wrong, but I believe a co-founder of Fundrise, which is, one way to get some exposure to real estate. Ben, welcome to the show.
Thanks for having me.
So I've been waiting, I've really been anxious to have this chat with you because I've got a lot of questions about Fundrise, and I thought, well, rather than doing all the research myself, although I've done a lot of it for this interview, I could, just get the answers right from you. And so I thought the way we might start today is just, let's imagine someone wants to invest, I don't know, $500 into Fundrise. What happens? They send you their money. What do you do with it? Where does it go? What choices do they have? What happens to it?
Okay. Great question. So let me just preface it by saying that I'm on the more investment side. So my strength hasn't always been on the keeping it simple. So if you ask good technical real estate investment questions, I have probably better answers than this type of question. But so I'm gonna take that in layers. So first, the way our product's designed is around people's goals. So a lot of people have goals. They want to invest in income, or they want to look for long-term returns, like long-term appreciation or balance. So it starts with basically what are they trying to achieve, and then based on that, we will give them algorithm give them an allocation of funds, and the funds would have more of a focus on yield versus long-term appreciation. As an example, let's just pick it. Let's say they say long-term appreciation, that they're young long-term investor, that for a smaller investment, it would go into the Flagship fund. And the Flagship fund is a fund we launched about 18 months ago. That is our largest fund, and it's a diversified public non-traded REIT. So it's a publicly registered fund with the SEC, and that fund has a bunch of attributes around it. But one of the most important is that it's diversified. It's large. It's diversified into most of the real estate strategies we think are the best. And so that's the money would go into that fund, and that fund is continuously raising, continuously investing. You get a diversified portfolio, but it would continue to buy and invest into the strategies we think have the best sort of prospects in the coming years.
Okay. And so you described the Flagship real estate fund, and I did take a look at that as one option. And it's a non-traded REIT, I think you described it as, right? So one question that I get a lot from folks is, well, we can invest in publicly traded REITs, either a Vanguard index fund, which I know gets talked a lot about. They have both a mutual fund and an ETF version. You could invest in, a specific publicly traded REIT like Realty Income is a very popular option. What are the, advantages and perhaps the disadvantages of investing in a non-traded REIT like what Fundrise offers?
Yeah, so that is definitely a core question. So there's the public markets and the private markets, and the public markets are liquid and largely focused on more mature companies, and the private markets, like what a Blackstone invests in or venture capital, will focus more on higher growth, slightly higher risk, and then less liquidity. And so the big difference between the two is that most investors can't invest in the private markets. To be a direct investor in the private markets, at least for larger quality real estate and tech, you really have to be a qualified purchaser. So that means you have to have $5 million of liquid net worth. So the vehicles we created are really a mechanism to allow investors to invest into private markets where otherwise really they can't. And we do it much lower structure. So compared to Vanguard's really a fund of funds. Vanguard's a wrap of public REITs. And I like to think of a public REIT, compare public REITs to tech. Most people are more familiar with sort of private tech than they are with private real estate. So like Snowflake or Databricks or any, were high growth companies. Facebook, well before they went public, high growth. IBM is a mature, or Hewlett Packard, mature tech company. So largely what's in the public markets are more mature and usually slower growth. And what's in the private markets are this sort of higher growth, newer trends. And that's true pretty much with real estate. It's not, I think tech can be more extreme in terms of the differences, but it's largely true with difference between private and public. So that's really what's happening. And so both are still tech or both are still real estate. It's just like the where in the life cycle an investor's coming into that investment.
I see. And so Fundrise, because of the non-traded nature, you're at least to some extent getting real estate development projects in earlier stages than if you say bought a public REIT or a public REIT index fund.
Yeah, or it can be happening at the deal level. So typically in real estate, the deal level could be they call it opportunistic or value add. So there's more activity happening in the real estate where there's construction and renovation, lease up, and typically in a mature real estate deal, it's stabilized, fully leased up, and doesn't have that much happening at the real estate deal. So it can happen at the deal level. It can also happen at sort of the sector level. So real estate used to be like 20, 30 years ago, used to be office, retail, residential. Those are really the big asset classes. Industrial wasn't really mainstream. And then over the last 20 years, there's been a lot of change in real estate, and obviously office is dying, retail is dying, and data centers as a REIT didn't exist 20 years ago. Cell tower REITs didn't exist 20 years ago. Those two are probably the best performing REIT subclasses in the public markets last decade, and they didn't exist 25 years ago. And so you could have bought them in the private sector before they were public REITs, and then bought them again in the public sector. So emerging asset classes are often like an interesting area. Single family rental didn't exist, and Blackstone built Invitation Homes, then took it public, and it became a new asset class in real estate. Right now, we're investing in build for rent, single family rental, where you're building communities of homes. And that does not exist in the public markets. You can't invest in build for rent in the public markets yet. It's too early. It's going to probably take 5 to 10 years of building out the private part of that market where it's scaled enough and mature enough where it enters the public markets probably later this decade. So new trends can often be private market first, public market later.
Yeah. So a couple of questions that all that triggered for me. You mentioned cell towers and I think data warehousing. Are those types of real estate that would be in I'm looking at the list here, the flagship real estate fund that you offer, or some other funds that you offer, or are those not areas you've gone into?
We've not gone into those areas, and those areas are actually fairly mature.
Yeah.
So where we've been investing, it can also be geographic. Yeah. So geographic can be emerging trends, and another example. So 20 years ago, urban infill was not something that people invested in. Actually, like most of the public REITs were really suburban real estate, and emerging neighborhoods like Brooklyn and LA Arts District, or this sort of like this growth of cities it was a new trend. It just was absolutely new. And that was really captured mostly by the private market. So geographic trends can also happen first in the private markets and later in the public, the public markets are vast, right? So the Sun Belt as an asset class, 10 years ago, 5 years ago, gateway cities is what the institutional public investor said. So that would be New York, Chicago, LA, San Francisco, mostly those four, and then like London. And the money was largely concentrated in these sort of big cities, but actually it turned out to be the wrong decision. And most of the growth turned out to be in the Sun Belt. And so what's emerging, what's new, typically not in the public markets, because public markets, really have to be scaled before you get to the public. And so usually new and scale don't go hand in hand.
Okay. Well, you mentioned something as well, and I think I've seen some of these projects on your website, if I understand it, but these are single family home communities that you guys are developing. Am I correct? All of which, all of the units, the homes will be rented?
Yes.
Now,
Yes.
okay, that's interesting. First of all, does that exist? I know you're developing some of those projects, but are there communities like that of single family homes, all of which are rented at the moment, or is this brand new?
I mean, we built them and we've rented them. So it exists now. But if I said 3 years ago, there would have been zero. I mean, I don't know. Maybe there's some somewhere, but like,
Yeah.
it didn't exist as an idea. When we went to the home builders in 2019, 20, like they were like, they never heard of it. They weren't going to do it. They weren't interested. They were afraid of it. The home builders actually told us, they're like, well, they were worried if you put a renter next to an owner, it would actually devalue the community. And so, but then March 2020 happened, the pandemic hit, and people don't remember this, but home buying stopped, as you might, like everything else did. Everything stopped in March 2020. The home builders turned to us and said, actually, the idea is not
an idea now.
Maybe we're open to doing it. So we went under contract for $500 million of housing that summer, where nobody was buying housing, right? And we bought it for rent. So that's an example of something that like that doesn't exist in the public markets in the same way. You could do that in the kind of RMBS, CMBS, but not.
What did you just say?
Sorry,
what does that mean?
You can do more complicated investments in the credit markets.
Okay.
Credit markets usually asset-backed securities, but it's with public REITs. That's not what's happening. It's not the same type of structured investing.
Okay. So debt financing maybe, but when you want to raise equity capital, people aren't interested in these sorts of projects?
Oh, wait, sorry. Maybe I wasn't clear. I just meant the kind of structured investment we did with the home builders, where we basically forward bought, $500 million of single family homes to rent. Like you can't, that type of like structured investing it doesn't really exist in the public markets.
Okay.
At least on the public REIT side.
So you've built these communities already. Are you building more?
Yeah, we have, I think, 60 communities at this point. We have dozens more under construction.
So 60 that are already done and people are living there.
Yeah, thousands.
What's the occupancy rate? I mean, just roughly.
Yeah, I mean, basically, the product has wait lists.
Wow.
It's, we could be.
I'm sorry, but how big are these
occupied if we wanted to be?
Really? So how big? Like, are these communities of 50 homes, 500 homes? How big are these?
Typically, I would say that. So the average probably 70. And there's some is 50 and some are 150. And so like the ideal execution, the ideal like sort of layout. Let's just take one. You're in Atlanta, like outside of like sort of infill outside Atlanta. Atlanta's like got a lot of suburban sprawl, and we would build 150 homes. It would be branded, so it would be like called like Fort King homes, and there'd be a gatehouse and a gate. It would feel like like a real community come in.
Yeah.
There'd be a leasing center. There'd be a pool. There'd be a fitness center. There'd be a community center. So there'd be a lot. There'd be a dog park. There might be hiking trails. So you're building a lot of amenities that, like an urban infill apartment building, where they have in apartment buildings now, they have a lot of amenities, right? They have all those types of things you'd have in an urban context. We now put into a suburban context for homes.
Okay.
And so what you ideally want is to kind of create a sense of neighborhood.
Yeah.
And we operate them like multifamily. They operate as efficiently as multifamily, but they lease like single family. They live like a single family home.
So, and are these properties part of the Flagship Real Estate Fund? Or, because I know that if I go to your website and the offerings page, I see a number of E-REITs, I think one E-Fund. Mm-hmm. There's the growth, the East Coast, the West Coast, the Heartland. Mm-hmm. So the properties you're describing, are they part of the, I don't know if the Flagship is sort of your main fund that most new investors go into, but are they in that fund? Are they in these other funds? And what's the relationship between all of these funds, or how do they work together?
Yeah. So you asked two questions there. So first,
Yeah.
where are they asked? So this strategy is a new strategy. So it's in the newer funds. The Flagship fund, the largest fund, it's only 18 months old. So I think about 60% of the fund is in build for rent or in this strategy. So it's most concentrated in this fund. The build for rent is also a lot of some of our other newer funds are co-invested with it. So they might co-invest in these deals. The biggest difference between the funds is vintage. So we typically launch a couple funds a year. So the funds from 6-7 years ago probably won't have this strategy in it. They'll have a strategy we pursued earlier. And so as we launch new funds, they get basically different strategies between what's happening in the world.
So some of the older funds have closed to new investments, I assume then?
More or less closed, yeah.
Yeah. Okay. And Flagship is sort of the current one that's, there may be others, I suppose, but that's sort of the main one that's accepting new capital.
The main equity fund. We have a debt fund too. Like that's like a large fund as well.
Well, so let's just go there. What's the difference? The fund, is this the Fundrise E-Fund? Is that the one?
No, that's a different strategy, an older vintage. So the two main funds today are the Flagship fund, which is an equity fund, and then this Fundrise real estate income fund, and that's like the largest debt-focused fund. And they're two strategies really pursuing two different goals.
Yeah, because one invests in debt, among other things, so it's more of an income-focused, perhaps a little less risky, one might think.
Yeah, I don't like talking about risk, but
yeah, I hear you. I know.
We have goals around that. Yeah, I mean it's different. It's a different profile investment.
Well, and we all know debt can be extremely risky. But are these both REITs? Are these both sort of taxed as REITs?
Both are, yeah. Almost all of our funds are structured as REITs, but REITs is just a tax election, right?
Right. Sure. So one question then is, and we can use the build to rent model, but when you go into a new project, do you have an exit plan? Do you plan to sell this after 5 to 10 years or whatever? How do you think about exiting any of these projects?
Yeah, we've done hundreds of deals, and so it depends on so sometimes you have a plan at a deal level. So you might be buying something, renovating it, and then once it's stabilized, you might sell it, and we've done that. Or you might have like a portfolio strategy where you're like build for rent. It's really about building a large portfolio. I mean, it's I believe it's going to be tens of thousands of units. So it's similar to what Blackstone did with the Invitation Homes strategy. They build a large portfolio, and then often a large portfolio has a different exit. It might go public or might get bought by another large fund. So it depends on the specific deal business plan. And so every deal we underwrite and close has an investment memo, has a business plan, has model, and would have an assumption on exit. As you know, anything that looks out more than 5 to 10 years, 5 years ago, the world looked nothing like today. Like office is dead, right? Nobody who had a business plan 5 years ago thought office would be, basically obsolete.
Right. Well, so if someone invests in the Flagship real estate fund, is the money they invest basically just spread out evenly among all of the projects that are in that fund?
Yes.
Okay. And so is there ever a situation where, because you sell, and maybe it was part of the plan or whatever, but some of the assets in that fund get sold, that you would return capital to the investors? Does that happen from time to time? And I'm not talking about dividends. I know there's cash flow, but actually return of capital.
Yeah, we have that, especially now with some of the older funds that are starting to sell assets. And so we give the investor the option to either reinvest it or to receive it. It's a little bit different. Most people who invest don't have experience in the private markets or private funds. They're mostly experienced with the public markets. So put your money in like public funds and they just give it back to you, right? It's
Right.
like it's like a little bit unintuitive to people when we just like, oh, we return capital to you. And like, wait a second, I didn't ask for my money back. Why did you give me my money back? So there's like it's a little bit of divergence between the sort of a private market player who has experience in that context and a public market investor who doesn't.
Right. Well, where I'm kind of going with this question, and I'll preface this by saying there's no way anything we talk about today should be construed as tax advice. I think that's fair to say. But investors, particularly if they're not investing in an IRA, and I know you guys offer IRAs, but if they're investing in a taxable account, they got to consider taxes. If you're investing on your own in real estate, there can be some pretty significant tax advantages, but of course you have complete control. If you're buying a single family home, and you can 1031 it into a new property down the road if you want to sell it and get into something else. You can borrow against it. You might not pay any taxes on the cash flow for years because of depreciation, right? But I'm guessing when you get into funds like Fundrise or any other non-traded REIT, I got to believe a lot of those tax advantages don't carry over. But I don't actually know that. And so it's really more of a question. Are there tax advantages that are available to investors in say the Flagship fund, and how does that work? Again, just at a high level, if you can give us some idea.
Yeah. So the advantage of the REIT structure and a fund structure is that you can achieve very comparable outcomes from a tax point of view. So one of the reasons we moved to a flagship fund that was like meant to be evergreen long term. All of our funds are potentially evergreen, but it's the flagship fund structure is much better for long term investing. We have and we will often 1031 the properties if we sell. Let's say we sold. This is a real example. We had bought an apartment building in Orlando, and it was about 200 units, and then we built 50 more units next to it. We bought it 5 years ago, so we bought it really, really cheap. There's been a huge appreciation in apartments, and we also did some value add. We sold that, and we'll 1031 it tax free. 1031 just means, as you know, a tax free exchange in real estate, like for like kind assets. So we will do that in order to basically essentially prevent the investors from having a taxable gain that otherwise they would need to take, and that's something that you can do in a larger fund structure. And so,
right.
But sometimes we'll look at a deal, and there just won't be a good reinvestment. There's 1031. I mean, if you look back about a year ago, any asset that was stabilized, you really have to 1031 into a stabilized asset. You can't 1031 into a value add asset. It's really challenging. If you want to get into the details, you may know a lot about this, but sometimes you're better off paying taxes than buying something that's too expensive. And stabilized assets last year when interest rates were 2% were just priced too high. So we took the gain, and that was, I think we're better off.
So in that situation, an investor would get their tax document, if it's a 1099 or K1, but they're going to get, they could in theory get some capital gains in any given year.
Yeah, but the equity REITs that we have, if you look at the 1099s, like there's you might have, it depends on the year, but a lot of income on that 1099, but it all will show up as return of capital because we have a lot of depreciation and shelter.
I see.
So the good thing about real estate, right? It's so tax efficient. It's much more tax efficient than maybe oil and gas, but other than oil and gas, much more efficient than most other asset classes. So we have 5 tax professionals on our team that all they do is try to figure out how to make things the most tax efficient as possible.
Is there a way for investors who are considering Fundrise to figure out, maybe you have resources on your site, I can link to them below the video when we're done, if you send them to me, but that can help people kind of get their arms around what the tax implications would be if they started investing in Fundrise?
Yeah, I'm sure we have tax. I mean, the challenge with tax is that there are people who don't know that much about tax, and there's people who are really, obsessed with the tax code. And I can go, I'm 25 years in real estate, so I can go down into like a lot of the complexity if you wanted to. So when we've had people, our tax people, right, they've worked at Carlisle and places like that. So we do a lot on that, and we can share.
Yeah, anything you can share, I'll definitely add it to the video. I mean, at one level, first of all, if there's dividends, right, that get distributed, which REITs have to, right? They have to distribute what, 90% of your income?
Taxable income, though.
Yeah, okay.
We're typically distributing like the income that's like, if a property has, let's just do an example. Property is $100 million, and let's say there's cash flow is $7 million. You probably have shelter of almost all of that. You probably aren't paying any capital taxable gains on that because of the the leverage and the depreciation. So there's oftentimes you're getting that 1099, and it's basically showing up as return of capital because it's sheltered. I mean, I feel like you actually know what I'm talking about. So I'm not good. This is where I'm not that good at. I'll get into the technical, but I'm not good at making it necessarily like as simple as I should.
No, you're doing great.
Okay.
Yeah. Well, any information you can send us that maybe is on your website or whatever, because I think that would help people. So another area I want to dive into is how you value, like the net asset value of a share, say of the Flagship. So if I'm going to buy in, and I give you 1,000 or 100,000, there's a certain per share value, net asset value, and because it's not publicly traded, you don't have a public market to value these assets, right? So I've done some research, and depending on what it is, maybe you value them quarterly, it can be a little different, but that's obviously pretty important. And so how do you go about valuing these assets? If, again, just at a high level. But
Sure. So let's just do some simple examples. Let's say you have a portfolio or a fund, and it has 5 apartment buildings, 5 e-commerce logistical buildings, and at least 5 built for rent communities, right? So it has a certain number of assets. You take an apartment building, we usually are buying in the Sun Belt, and we own something like 20,000 apartment units across the Sun Belt, and you can see every single trade. We have every single property that's sold in the last 10 years that's comparable. You can look at the income, and you can look at basically essentially what cap rates are, because you see every transaction, and you can know within a pretty tight range, plus or minus 5% at most, what the value of that building is. And it doesn't really change that much. I mean, it's different than the public markets. Public markets, you can have an announcement about China, and public markets can fall. But the true value of an apartment building in the private markets, it just doesn't move around that much, and it's pretty straightforward. I mean, if you buy, I've bought so many apartment buildings. It's pretty straightforward on what that is, what's that worth, and it moves much slower. Like right now, cap rates are rising because interest rates are rising, and you're seeing those transactions happen, and so that's basically what's happening. We also have third parties come in on an annual basis, both the auditors and appraisers. But it's just so straightforward. How to value these properties is not that complicated. And so that's basically so you have a combination of people, independent third parties, and software kind of checking values.
Yeah.
That gets aggregated up to a total value. And that basically is what creates the asset value of the property.
And you mentioned audit.
Yeah.
You mentioned auditors. Do your auditors test the valuations that are done?
Yeah, they do 100%. They don't even do sampling.
Really?
Yeah, because it's a 40 Act fund. There's
Okay.
they actually do 100% testing.
Okay. I was an enforcement attorney in the Public Company Accounting Oversight Board.
Okay.
Which they wouldn't regulate audits of your company, I don't think. They regulate auditors of publicly traded companies, but 100% testing is that's good to hear. That's pretty
Yeah,
significant.
our
Because normally they take a
CFO.
statistical sample.
Yeah, if you're
Yeah.
so now I didn't realize that you knew so much. So our CFO was chief accountant at the SEC
Okay.
for
What's
IM
the
division
CFO? What's that?
for IM for investment management.
No, but what's his name?
Oh, her name is Allison Stallo.
Okay.
So she just left a year and a half ago. So she's like maybe different. She may have been there
Yeah.
after there. So she was there for 5 years. So and they actually rewrote the NAV rules while she was there. She basically wrote them. And so like we could start talking about like 820 and 946 and all the stuff that you have to do. It's like it's a lot. It's a lot. I mean, there's
So do investors have access to the values you're placing on each of the properties in, say, the flagship fund, if they're in that? What level of access do investors get to that data?
a good question. I don't know off the top of my head. I mean, I actually am trying to figure out how to give. Like we now have software. Our business, we have software that goes from the property real time all the way through to the investor. And I would love to be able to figure out how to give that. It's like one of those things where, like, we need to basically figure out how to put it on Edgar in order basically to be able to give it to investors. So we're still trying to figure out for me, like, there's no secret sauce. Like everybody can see it. It's not, so I don't know how much we do a lot of filings, like something like 1,000 filings a year. So we put a lot of it out there. But the problem with Edgar is this is not how people normally consume information. So
Yeah.
Edgar is where SEC public filings go. So we put it in the public domain, but it really wants to be in the app, and we haven't figured out how to basically put it into the app.
Is it in the public domain under Fundrise's name or your parent company, or what name
It
is it
would
under?
be by fund. So the
By
asset,
fund.
it would be in the, like, so if you get to the Fundrise Renewable Fund, you'd see, or whatever the funds, you'd see all these filings. You see tons and tons of filings. We'd file for every asset.
Okay, I'll look at that. That's helpful. I'm curious, when you sell a property, like you sold the Orlando property,
Mm-hmm.
do you look at that and say, okay, we sold it for this much. Now let's go back a quarter or 2 quarters. What were we valuing it at, say, a quarter ago? Because we just sold it, so now we have an actual arm's length.
Mark, yeah.
And do you do that to sort of test your valuation methodologies?
Yeah. Well, that's actually required under, I think, 820. So, like, this is like AICPA and stuff. So you know this stuff better than me, but I've basically been here long enough. I had to learn. So yeah, back testing, definitely part of the regime. That's actually easy because when you go out, you're going to be in market for 6 months before you actually sell. 3 months to market, 3 months to sell.
Yeah.
And so as you're valuing something, you're trying to, like, you're trying to have your valuation hit that mark, and you're trying to say, okay, this is going to close, and so and that's what I mean. Yeah, we've sold. I mean, we've turned 100 plus real estate deals over the history, and like this is one of the things. Like we've also been like audited to no end by OC, and they've like lived with us for years. So they come in and they're testing like they come in and say, well, is this value right? I'm like, well, we sold it, more at like around that price or more, like 3% more, 5% more, like it's you can't really have an issue with that. So
Right.
that's the easiest thing. That's one of the great things about like been around so long. You can see all the activity in just the empirical side of it.
So I want to talk briefly just about fees. I believe your fee, it may be 2 fees. I read there's a 15 basis point and an 85 basis point fee. But so collectively, I think, tell me if this is right, investors have about a 1% fee.
Yes, although there's more complexity. So let's work through it.
Okay. Well, I know there's and if there's more complexity on this, let's dive into it. I do know there's also I think it's a 1% fee if they sell before 5 years. Do I have that right?
Okay. Yeah. So our original funds, which were before we started the flagship funds, were a different regulatory structure. So they were more akin to private funds, and those private funds and we, when we launched, we were doing something totally new, right? No one had done anything like this on the internet. So we thought we needed to create like a disincentive for people to liquidate early. And so we created a fee structure that said, if you liquidate, early, you pay like a fee that declines over time. And that fee went to the other investors, didn't go to us, right? It was just like, because the people who are basically, if you're liquidating early, the people you're liquidating from are other investors, so they should get like that liquidity premium.
Right.
We've been around for 10 years, we learned that basically it wasn't actually worth it. We got rid of that for the flagship funds. I think we might have gotten rid of for more funds. So now there's no penalty to come in and out. And the new funds have like basically guaranteed liquidity for each quarterly repurchase of up to 5%. So it's a much better structure. It's bigger, it's more scalable, it's lower cost. So that's why I said it's more complicated when it comes to the fees.
Okay. Well, are there fees if someone sells? I guess that's the question. Are there fees?
Not for the new funds. There's no.
Okay.
Fee.
But then, is this almost like an interval fund, effectively? Then, where
they are interval funds? Yes, they are.
So we can focus on. We can focus on.
I didn't know you knew what an interval fund was. Okay.
Yeah.
But you did. I didn't. You know what you're talking about.
No, that's okay. But I know older funds might have been different. We can just stick with Flagship because that's going to be, I think, relevant for most folks watching. Mm-hmm. And so you have quarterly redemptions, right? Up to I think you said up to 5%.
It's 5% minimum.
Oh, so if you want to redeem some of your investment, you have to redeem at least 5% of your investment?
No, I'm talking about the fund level. So a $1 billion fund, we have to be able to set aside $50 million for redemptions every quarter.
I see. And so if more people want to redeem than you have set aside, like if I might be limited in how much I could get back in any given quarter, in theory.
In theory, yeah. I mean, we've never come close to even to 5%. I mean, it's usually less than half of that. So I mean, even like for me, it was interesting. So I've had it happen twice, right? It happened March 2020, which was a period of distress in the stock market, and then in June 30, you know, those few months leading up to June 30 had a lot of bad news. The stock market was down something like 30%, and both times, like our redemptions were still way below 5%.
Okay. So just so I understand this, you have $1 billion fund. That means each quarter you guys set aside at least $50 million that you'll pay out to investors if they want it.
If they want, yeah.
So if I've got $100,000 in there and I want all of it back, I might be able to get it. Just depends on what other investors and if it caps out.
Right, but I mean, our goal is to always be able to redeem everyone who wants out, and so we manage that with lines of credit, with liquid assets. I mean, our typical fund has some meaningful part of it in liquid assets because the customer wants it to be liquid. So we want to satisfy them. So that's like we portfolio manage the assets to make sure that that's like, that should be true unless there's something very strange happening in the world.
So with the flagship fund, you can redeem every quarter. And you could do that even after one quarter if you wanted to.
Right.
And there's no fees to do that.
Right.
Okay. Because I did see that some funds, I think, do have a 1%.
The older funds did. And I believe I don't remember now. I feel like we were planning to or got rid of that, but I can't remember. Because it's just, we discovered that it was just like, it was just creating unnecessary friction.
Well, I know from I think it's an October 21 article on your site. I know it was 2021. You'd gone from a fee of potentially as much as 3% down to 1%.
Mm-hmm. I know. Maybe
since then you've eliminated the 1%. I don't know.
Maybe it's just 1 at this point. But again, it doesn't go to us. It goes to the fellow investors. So
okay. And the flagship.
Yeah.
Go ahead.
So it's not to generate income for us. It's basically generate the right.
Well, and some mutual funds do something similar, including at least historically Vanguard funds. Some had, to discourage active trading. I don't know if they still do, but
Yeah.
so for the flagship fund, does it pay a predictable dividend, some sort of cash flow?
Yeah, it pays dividend, but it's, that strategy has been largely in a heavy value add. Like we were, up until recently, there was way more value in called value add or opportunistic real estate. And, because what happened was interest rates had been falling for over 30 years, but certainly last year and the last couple of years, interest rates were so low. If you bought anything that had yield, you were going to be paying a really high price. So we were mostly in the equity fund doing value add real estate. So that would be like the built for rent, right? You're buying things that are vacant and you're leasing it up. And so the current dividend was lower, but the appreciation was higher. So we have some, but now, what's happening in the environment is you can now actually invest in yield and get pretty good pricing. So our strategy for every fund will evolve with the market. So dividend has been low, but appreciation has been high. I think that strategy for everything is going to shift because the credit markets are more attractive than the equity markets today.
Right.
Yes,
Well,
I'm answering your question with a different answer maybe than you were.
but the fund does pay some amount of dividend each quarter.
Sure. All our funds pay dividends, yeah, but it can range from like 2 to 8% depending on the fund.
Well, what's the flagship? Do you know just off the top of your head, or?
I don't know off the top of my head. I know it was lower because we really were investing in value add, but I don't remember.
Is that information available on the website?
Oh, yeah, definitely.
Okay, all right. So you talked about credit markets and interest. So let's dive into that. Inflation is a big story for everyone. Interest rates are going up. Jerome Powell said interest rates are going to keep going up for a while. At least that's how I interpreted his statement at Jackson Hole. I think that's how everyone interpreted it. So how do you see that affecting real estate in general, and maybe even more important, the investments that someone could make in Fundrise?
Yeah, so this is like an important point, difference between like Vanguard and us. There's so many differences. It's funny, Vanguard, because you really should be comparing us to Blackstone, but it's not a normal point of departure. So our funds are actively managed. And our active management, is our point of view. So we felt that inflation and interest rates were going to stay high for a long time. And we wrote a letter to our investors in beginning of January saying, this is going to be a lot higher for a lot longer. And back then, January, people were saying that, quote, inflation was going to be transitory. And we thought that was incorrect. So in order to have made money properly on this question about inflation and interest rates, you really had to have made that call way before anybody else had priced it into the market. And so for the last almost 10 months, right, the market has been fighting this point of view, and it's slowly but surely realizing that inflation is going to be much harder to tame, and interest rates are going to be higher for longer. And that basically, I feel like the market's finally done with fighting it with this recent announcement last week in Jackson Hole. So this has been a 10-month, basically view we've had. And the way we manifested that view is we actually had a lot of cash reserves. We basically were not investing into the price regime, whether you're buying credit or you're buying equity, apartment buildings. We basically said the market hasn't priced this properly. So we built up a lot of cash, and for the income fund, for example, we were in 25% cash, and the dividend fell, and some people were frustrated and said, yeah, but if you'd bought into the old regime, you would have lost. Literally, debt markets fell, treasuries fell 10%. You would have lost money if you'd been heavily invested in the old asset regime pricing. So we built up, all dry powder, including lines of credit, probably $700 million of liquidity. And we are now deploying it into a totally different pricing regime. And it's been phenomenal, right? But there was a period where people were frustrated because they don't, there's you had to take this point of view like before the market did. And we,
Right.
you know, we could have been wrong, right? Somebody said, you're wrong. People told us we were wrong. Interest rates are going to be, you know, interest rates and inflation will be transitory. And so, sorry, no, that's a longer answer, but there's,
No, it's helpful.
yeah.
So basically, you were holding cash at a time when you thought we were going through basically a repricing of real estate, and now you think we've kind of gotten to a point where it makes sense to deploy more cash.
Yeah,
That's
yeah,
fair?
that's true. But it's repriced in the credit markets, but it hasn't repriced in the equity markets yet. So like credit markets, this goes back where we started buying asset-backed securities recently.
Yeah.
So that's like, you know, RMBS and CM. We don't actually not CMBS. I hate CMBS, but RMBS is particularly around single-family rental. We've been buying asset-backed, and we've also been doing direct lending. So that market's really become attractive, and the equity markets only along the edges have repriced. So we're still waiting for equity to reprice. But when it does, you know, we'll then move there too. So there's like, that's what I mean by it's much more active than most people see in a fund manager.
Yeah.
I mean, all that.
Let me,
We also go active. Sometimes we're public. We do go into public markets. Like in March 2020, you would have wanted to go into the public markets when it fell 40% and come back out when it came back up, right? So there's like the fund can do public, private, or it can do any asset class, or it can do credit, or it can do equity, and that kind of discretion, I think, is critical to basically move the way the markets move today. The opportunity to like shift between all those different parts of the market structure pretty rapidly.
Right. So I guess kind of related to that, we've talked a lot about the flagship fund, but how many, for a new investor, how many different funds do you offer a new investor today? How many different funds can they choose from?
It depends on the size of their investment. As they write bigger.
Let me show you something.
Okay. There it is. Okay.
Can you see it?
It's a little small. Okay.
Yeah, I can try to make it a little bigger.
Okay. Great.
Is this what you mean by size from $10 up to 100 grand?
Yes. Yes.
Can you kind of explain this to us?
Oh, goodness. Okay.
Well, I mean, I don't need detail like, you know, each line item, but just generally, what are the funds that are available to folks and how does it change as people have more to invest?
Right. Well, what we found is the bigger the investor, the more opinionated they are.
I get that might be true.
And so we, to accommodate them, like we've created a little bit more discretion in terms of like of all the funds we have, they can get more allocation discretion. We're working on a product to make that more broadly available so that more people can have allocation discretion. But today, the bigger investor advanced premium has more choice. So it says directly allocate to funds in the bottom, on the second to last bottom. So that's what we're talking about. You can also more custom. You can customize the portfolio. Yeah. So the bottom 2 or 3 are about customization, right? Custom portfolio, directly allocated funds.
But now, this directly allocate to funds, is there a place where you list all of the funds that are available?
Yes. You won't see it unless you're in the app.
I see.
It's not. So it's not publicly.
Okay. So Flagship is just one of those funds.
Right. I think there's 20 at one point.
20. Okay.
Mm-hmm.
And then what does this premium priority access to investor relations team? And here it says one of a kind offerings designed for accredited investors. What can you tell us about that?
Sometimes there are investments that just don't fit the current fund strategies. And so in that, like for example, we created an opportunity zone fund. If you're familiar with that, if you know.
Aren't there some good tax advantages to those?
Yes. But the tax advantages only are useful to people who have really large capital gains. It's not useful to somebody who's like got a $5,000 gain. It really needs to be a significant capital gain. So we have a Fundrise Opportunity Zone fund, and that's an example.
Okay. Well, if someone wanted to learn more about that, I'm going to try to switch back over to our normal setup here. If someone wanted to learn more about that, for example, can they call Fundrise? If they create an account, will they see all of that information inside the Fundrise platform? What can they do to learn more about those sorts of opportunities?
That's something we're building. We need to do a better job on. We really, the premium investor usually organically grows up in our platform. They usually start by coming to us skeptical.
Okay.
And I'm okay. I'm a skeptic. So, and then after time, they invest with us for a little while. They're like, oh, actually, this is like pretty good. This is interesting. Like, do you guys have like other products? And that's when we normally say, yeah, like, but let us like understand what you're looking for. Hopefully over time, two things happen. We can create like a more structured approach for that, and also make that available to people, not just based on net worth, but based on sophistication. But we haven't. That's something we're working on that probably won't be available to next year. So it's it's a work in progress and some of the things that we need to do.
Okay. Well, that's fair enough. I'm just looking through the chat because some folks have been asking questions, and I think we've covered most of them. I do know that one question that comes up is for your older funds, the different liquidity rules. When can they take money out? Are there fees? And I was initially sort of avoiding those questions because new investors would be focused on Flagship or one of the other existing funds. But I think there may be some folks watching that have been with you guys for a while and have some of the older funds. Feel free just to walk us through it, or if there's a place you can reference on the website that will walk through this. I would think on the platform, if you are in one of those older funds, you'd be able to see it on the platform what all the rules are.
Yeah, I want to say that an older fund you should be able to redeem now and at par with. And so, because the whole point of it is that it's only a penalty if you're redeeming early, right? So if you've been in an older fund, it shouldn't have a penalty anymore. So I'm not, unless you've invested in it more recently, right? Then I don't think you should be able to redeem out. It should be no problem to redeem out, and there shouldn't be a penalty. That's what I want to say. There could be exceptions, like because we have 400,000 investors or something. So there's a lot of use cases that people have. It's amazing how many interesting stories there are out there.
Okay, fair enough. I'm seeing one question that they're saying if they're in some of the old funds, I assume there's nothing stopping them from adding new money and putting it into any of the new funds.
No. No, and honestly, one of the things I wish we had built, but we're still working on, is a reallocate. So you could allocate, and the goal by next year is to create more custom allocations that you could say, okay, I want to custom allocate more towards this or that, more towards like, let's say, I want more build for rent, less industrial, or I want these newer funds. So there's like a goal to build that. That's something that by next year we should have built. So you could say, not only do I want to invest in new funds, but I want to allocate out of the old funds. Like that's something I think people should be able to do.
So two questions there. If you pick how you want to allocate, I want this kind of real estate, that kind of real estate. I take it when this is built, the platform will take that and put money into different funds to match whatever that allocation is. So you might be in 4 different funds or whatever. So a related question, and for those not watching the video, Ben is shaking his head yes.
Okay.
I used to do that when I was cross-examining witnesses when they would nod.
Okay.
I'd say, yeah, we really need you to give a verbal answer. Although I hope you don't view this as an interrogation.
No, it's fine.
Okay. Then the next question that comes to my mind is, if someone switches funds, like you just said, they want out of the old fund into a new one, is that a taxable event?
Yes, that would be taxable.
So there's no way to 1031 around that. So that's something for folks to keep in mind. Because they're effectively selling one investment and then just buying a new one. It's no different than, say, changing mutual funds.
That's true. It's just as I sort of alluded to earlier, I've learned there's two kinds of investors out there. There's investors who like very active and have strong opinions, and then most investors, like especially on it really gets down to the type of stuff we're doing. It's pretty complicated. And like most people say, like, look, I'm not a real estate expert, or I'm not a, whatever fund structure, there's lots of things out there in the world. And so most people are passive investors. And so that's really what we're working on trying to do. Give the active investors what they want. Like, let's say that a lot of investors say, we want to go into industrial. And we raise they allocate a lot to industrial. And we're sitting there saying, industrial is priced pretty premium today. Like, we can deploy into it. It's fine. We know exactly how to do it. But like, we probably would be allocating you to build for rent. Like that's the one challenge with active investors, is that they drive allocation, and like, unless you're really on the ground, like, you can't tell what's good from newspapers. That's just not telling you what's happening.
Yeah. Is there advantages? We looked a minute ago at the Fundrise website, where you can start at $10, but you go up to 100,000 or more, and you get other options. Are there advantages for folks listening that have 100 grand or 500 grand or $1 million that want to invest? Do they get access to investments through Fundrise that, if I've got 1,000 to invest, I'm not going to have access to?
Our mission was that like, not to create barriers based on wealth. Like, it's we use software to basically lower the marginal cost of investment to close to zero. Like, the whole investment world, like where I came from before Fundrise, like, the bigger the investor, the better the deals. Like, special treatment. They're really selling like red rope, kind of velvet rope access.
Yeah.
And so I don't like the idea of like sort of the best investments for the biggest investors. It sort of runs counter to our values. What we try to give people is more choice, because maybe there's different tax benefits. There's things that make sense for large investors, like they have more sophisticated support they may have because they have sophisticated situations, but not typically like based on like an investment. Like,
Yeah. Okay. Well, let me just check. You've been great. I appreciate you answering all these questions. Sometimes we've gone down into the weeds.
I love this. This is the kind of conversation I like.
Well, okay. Well, then hopefully you'll like this question.
Okay.
I'm just looking at my notes here. You talk about customizing portfolios, and I know from the website you have fixed income, core plus, value add, opportunistic.
Mm-hmm. Mm-hmm.
Those are how they're described. And I kind of view them as shorter term, all the way down to like opportunistic. You could be a while to get cash flow back, because you're maybe rebuilding something or starting from scratch, or as opposed to investing in a property that's already fully leased and ready to go. You're just changing ownership, right? But I take it for investors, are those sort of 4 levels still available on the platform, and you can pick which ones you want?
Yeah, and it's really weighting towards those things. It's most like apparent around fixed income versus appreciation, which is intuitive. But you're right. So like, if I take opportunistic, usually we have a fund called a development E-REIT, and it does development building, mostly apartment buildings throughout the Sun Belt. And I look at those investments and I look at it and say, oh wow, like that's a really good basis. Like, if you can build an apartment building for that price, that basis, like per price per unit, like I feel confident that's gonna be a good investment. But in the, it takes like, especially with COVID, everything got delayed, permitting got delayed, construction got delayed. And those delays, it's really hard to capture NAV value in those types of investments, because like, what's the value of a half-built apartment? Really, it's not half of the upside, right? It's much more of a like delayed pop. And so we have a fund like that, and I like the investments, but it's such a delayed gratification, and it's a challenge. People, I mean, like, so much of good investing is about delaying gratification, and it's
true.
Even when people say they want it, I'm always like, do you really want it though? Like, are you sure you're not going to complain a year from now? So,
someone in that kind of fund, could they go years without receiving any cash flow?
Yeah. I mean, you're building. It's literally like there's land. You got to
Yeah.
like get it permitted. There's like the permit offices we're shut down for a year. You couldn't even like get freaking permit in some places. I mean, it was the last couple of years with construction. I mean, and this is what I like. People don't realize, like, we have 100 software engineers and we have like construction managers. And we have like the full gambit of everything it takes to deliver outcomes. And, like I'm signing documents for easements and like, moving protected turtles from like one part of site to another part of the site. And it's a lot of like people don't realize Vanguard does is just like algorithmically allocate you to some stocks. Like we're doing real work. I mean, this is the real difference is to think of it as a primary versus a secondary.
Mm-hmm.
A secondary is somebody's buying a piece of paper that John bought it from Bob bought it from Susan. A primary is your money's going into the real world to build a real thing. Fundrise is a primary platform. Your money's going into the real world, hopefully to build good things and hopefully make money. That's not how most people are used to investing.
So and I'll make this my last question.
Okay.
By the way, where are you located?
I'm in DC.
By the way, that's not my last question.
Okay. Washington DC. Yeah.
Okay. So I'm in Northern Virginia. So we're
okay. So
we could have done this. We could have done this in person.
Yeah. And projects that we built then. I could name them. You will have heard.
Can you name one? Maybe, I don't know. I live near Tyson's Corner.
All right. I mean, this is before Fundrise did Gallery Place on 7th and H. If you know that, we did. Going back.
That was years ago, wasn't it? That was a long time ago.
Yeah, I'm saying before Fundrise. That was just fun.
Wasn't that in the 1990s?
We built it early 2000s. Early 2000s. We broke ground.
This is going back, but back in the day, I was on a team that defended former Congressman Dan Rostenkowski. He was a congressman out of Chicago. And I had to go to this trial, not of him, of a witness. And it was right there. And they were building, it was huge, but maybe Gallery Place came, maybe I guess you said early 2000. So it was a few years later.
It was a huge project. I mean, it took us years. We built it. I mean, okay, I'm just going to, I know this is a divergence, but you seem to be okay with it. So, when we started that project, I mean, I was like just out of college. Nobody wanted to build in cities. Cities were dead. That part is where 930 Club was based originally. If you know downtown, that originally 930 Club, 930 F Street. And so you get your back windshield smashed. It was really sketchy. People were like, well, downtown, can we ever come back? Because, DC had gone bankrupt. So we basically started that project. We had a Virgin Megastore, a Borders Books, a Jillian's, and AMC. We started construction. It was 750,000 square feet, $350 million development. By the time the building had been topped out, all of those retailers had gone bankrupt. The Virgin Megastore is long gone. Jillian's went bankrupt. We had to convert it to a courthouse. And so we built a thing, and it was and then 2008 financial crisis happened, and it was more problems. And then we sold it because downtown DC was like a fortress, like the most valuable thing in the world. And then 5 years later, right, downtowns are dead again, right? Downtowns are dead. There's nobody there. That project, we sold it to a large pension fund, and it's basically like end of, that they've lost tens of millions on that deal.
That's a shame. I mean,
my point is that over a 20-year period like that, you can see that sort of that's how real estate works. I mean, it's everything happened.
That area of downtown is great. I mean, even now, I mean, and you're right. Back in the 90s, DC was rough. I would be, even where our law firm was, it was scary at times. And but the federal courthouse is down in that area, and that's why I was there, and I saw a lot of that construction every single day. Okay, so my last question is, you mentioned build to rent, so maybe that's the answer. But what area of real estate has you really excited, say, over the next year or two? What are you really looking?
Maybe two answers. Like in the short term, I'm really excited about the debt markets. Like it's really been interesting. It's not an area I had been an active investor in before, but like you can go buy like asset-backed securities for multifamily, and for the same residential, for the same kind of assets we buy, you can go buy in the debt markets and like at huge discounts. So like what happens in every cycle, 2008, 2020, is that the liquid markets have a lot more dislocation, and you can actually really play. So it's been really interesting. I think it's going to be really interesting. But over the longer period, I think build for rent and just the work from home movement is like I think it's the biggest thing happening in our society, right? People used to live on farms. No one lived in an office. No one went to the city. Then they moved to the office. That was 100 years ago. Like 50 years from now, no one will go. Offices will be gone. Like, offices are over. I just think it's this massive sociological shift, and how and all that value is getting pushed to residential.
Yeah.
So how you pick that up, how you build community, how you basically like create the right kind of lived environment, that because you're working from home.
Yeah.
Like, I think there's a lot of opportunity in that, and you can layer on solar, you can layer on energy. There's a lot of things in this that I think are exciting. That's the real estate side. I mean, the finance part of me is excited about the asset-backed securities, and the real estate part of me is about like.
So is Fundrise, so the income fund, is it investing in asset-backed securities?
Just started.
If I were to invest in the income fund, I would get exposure to mortgage-backed securities.
We made our first transaction a couple weeks ago in a primary, which I think we put out there. I know we put out an Edgar that like we bought like the controlling interest in the F class. It was great. I mean, it's been phenomenal.
What kind of yields are you seeing?
That was a 9.5 yield.
Really?
Yes, unlevered, and we could repo it, and get 11 or 12. So it's
okay. Wait, stop right there. I got to ask you. You could repo it and get 11 or 12. That sounds like the coolest thing I've heard all day.
That's what I told you.
Yeah, I know what a repo is, but how do you repo it and get 11 or 12? You saying you could turn around and sell it and sell it at that kind of?
No. Basically,
explain that to me.
Your bulge bracket bank will lend you against your bond, like you own bonds essentially.
Yeah.
And so they'll lend against your bond. It's like margin. It's basically just lower cost. It's like primary. I mean, repo market's really where like the core liquidity of the financial system. And so if you get big enough, you can basically start borrowing at repo rates. And so we didn't lever it yet, because I'm always worried about short-term leverage, but it just tells you how attractive the market is, right, for debt as an investor.
Right. So the repo market. So you're saying you've just taken cash you have and bought debt. You could tap the repo market to get access to more capital to buy more debt.
Right. But the way that I would do it is I would do a portfolio. So you wouldn't want to have one name, because there could be volatility in a single name. So like our thinking is to try to buy more, and then you can get better rates for a portfolio of debt. And so that's underway right now. It's because it's, again, only when Jackson Hole meeting happened did the markets finally say, okay, we're talking about more than 4% Fed funds rate for the next year plus 18 months. I think it's through the end of 2023, right? So, and the market literally said that rates were going to fall in February precipitously. Like that's what the forward yield curve was saying. And so we basically, the forward yield curve is never right. Basically, that's one thing you have to.
Right.
So, sorry, maybe we got a little bit into the weeds.
No. I mean, well, the forward yield curve is what it is, right? I mean, it's investors' best guess, and it changes, all the time.
Yeah, but ultimately, investors' best guess looks like a quantitative decision, but it's really an emotional decision, and it's based on a lot of people are talking their book. So, anyway.
Well, I mean, you can even look at the Fed, and they put out their projections, and they're never right. I mean, they're always off in some way.
Yeah, of course they're never right, but this is where, there are people who spend all their time on this, right? But I couldn't understand why the market the Fed was pretty clear that they were going to try to tame inflation. Inflation's still over 8. Why people think it's going to reverse so quickly, I just don't understand that view. Even though it was widely held, it's just anyways, like,
Well, we'll see what he does. The way I read Powell's statement was to say, look, we may not be at 9.5 or whatever we were at, including energy and food, and we were in the eights, and maybe it'll come down. But what I heard him saying was, we don't see anything as it stands now that's going to bring inflation back to where we need it. You know, a 4% or 5% inflation might look not so bad compared to 9.5, but it's really bad compared to where we should be. And what I heard him saying was, it's not going to be easy to get it back down to 2.
no,
And it's going to take some serious time and some serious pain.
yeah, I mean, this is like, I think that's where we have to go from now to like 4. But then there's like, my next question is, can you get to 2? Like, I think you might not be able to get there. Like, I think the structure of the labor market is basically completely transformed, and you're not, there's been no immigration of consequence for almost 4 or 5 years, and that means there's 2 million less workers than there would have been, and so globalization is in decline. So I think there's a really good possibility that inflation is not going to come down to 2. That's not what I think. I think it's the Fed's going to it's going to hit some ceiling, basically, where they can't really raise interest rates anymore without causing like a depression, and the structurally interest rates and inflation are stuck higher than they were. And so like that's going to be an interesting question, but I think we're 18 months or so from that point.
Well, how do you deal with that from the perspective of you're building all of these for rent, for rent properties, and you have other residential properties? Because if unemployment starts to go up significantly as they fight inflation, that could have an impact on your portfolio.
Yeah, there's a lot in that. So typically people move when they can't afford to buy, they rent. And so rental homes are like a little bit counter-cyclical with the economy, and it's why I just generally lower risk than like office or other kinds of asset classes. So I think that I'm not particularly worried about sort of like rents and occupancy. I think the real question is, if inflation's at, let's say, stuck at 4, right, and they just can't get it down below 4 or ish. Will they keep interest rates at 4, or they have to take it below 4 basically, so the economy can like adjust to some measure of health? Because I think a 4% Fed funds rate is basically like economy essentially stops, because that's a 6% interest rate. And I think there's just a lot of pain in that. So I think there's 2 scenarios I think are likely. That Fed funds rate stays below inflation. So like basically Fed funds rate's 3 and inflation is stuck at 4. So you have sort of like permanent negative interest rates. I think that's a real possibility. It'd be great for real estate. And another possibility.
Okay.
Yeah. And the other possibility, which is what has been happening, right? We've had negative interest rates for a couple of years now. So I think that actually persists.
You mean real interest rates, right?
Negative real interest rates, yes.
Yeah.
I think that.
I don't think they're negative now, though, are they?
Yeah.
I guess they are. Yeah, I guess they are.
They are. I mean, like our rent growth is 7-8%, and we're borrowing, 4%, 5%, even 6% would be negative. So the other thing I think is going to happen, or I think likely to happen, is that they actually go back to QE while they have high interest rates. So they call it a twist, or yield curve control, where basically you have a liquidity crisis while you have inflation. And so you're stuck having to keep interest rates high, but pump liquidity into the market. And so it's almost like a Wall Street bailout, but I feel like that is also like really likely in the next couple of years.
Okay. Well, I guess time will tell.
Right.
I mean, if Jerome Powell meant what he said, I don't see him lowering the Fed fund rate with inflation at 4%. Let's say it's at 4% a year from now. I just don't. I mean, in fact, I think what he would say, I think Bernanke would say this. I just finished his book. Is that's the kind of mistake we made in the 60s and 70s. We don't want to do that again. But I guess, time will tell.
Yeah. That's why they might be pumping liquidity at the same time as they're keeping interest rates high.
Yeah. Well, and the other unknown is what fiscal policy will be, which obviously can have a huge effect on.
Right. And then, last of all, right, which is that, like, yeah, the 70s were such a different period. Like, doesn't mean what happened in the 70s will happen in the 2020s. So
right.
There's a lot of, like, fighting the last war here that usually doesn't work out the way you expect.
Perhaps, although, inflation is still a big number right now.
Yeah, right now for sure. But we're talking about, like, the period after this one. This one is like, it's written, right? It's written what he's going to do. What happens after that is, like, the part we're speculating on here.
Right. Well, Ben, this has been a lot of fun, very educational for me. I appreciate your time. Thank you.
Yeah, I loved it too. I mean, it's nice to talk to somebody who's so knowledgeable. And so if you have, like, any questions, I owe you some follow-up documentation. So we'll connect afterwards.
Sounds great. And what I'll do for those watching, it'll be later today, tomorrow, but I'll add links below the video to the resources that Ben sends over. All right. Well, I will say to everyone else, thanks for watching. Hope you found this helpful. Leave comments below. I'll be happy to answer them as best I can. And as I always say, until next time, remember, the best thing money can buy is financial freedom.